morning, Amanda.
Good morning, Simon. How are you?
Very well. How are you today?
Yeah, I'm all right. Thank you very much. I think we've got over the struggle of the end of January and everybody clamouring to submit their tax returns on time.
That's all done. HMRC throw in a few spanners in the work with their software, but you won't go into that anyway. Right. So today we have special guests. We have Patrick Soares from Field Court Tax Chambers, a colleague of Patrick Way, who was on a few weeks ago. And we also have an old client, a very well-established client, Michael Bennett.
I think Michael would rather you said well-established.
Rest of the old time.
As in, well, you know what I mean anyway.
Yeah.
Okay, so Patrick, we'll go to you first. Obviously, you're in a barrister who deals with property taxes. And over to you. Tell us about yourself and how you got into tax and what you specialise in.
Yeah. Oh, well, I've been in tax for a good many years. Formerly as a solicitor in the tax department of a firm of solicitors which specialised in land transactions, and lately at the bar. So I've spent a lot of time on land transactions, how to find the optimum structures, and also trusts, how they fit together. So what I'd like to talk about a little bit is some of the structures which are passing my way on my desk. What are they, or the questions being asked, and how I feel that we've achieved the optimum answer.
Yeah, please do.
And it's oddly enough, it's not enough to get it right nowadays. You've got to find the optimum right.
No pressure.
Yeah, so it's quite a thing. A client says, well, yeah, you got dead right that advice, Mr. Soares, but there's better advice. And therefore I'm going elsewhere. So really it's a very hard task. Anyhow, so
Patrick, sorry to interject, but just for my understanding, when you talk about land transaction, could you clarify what you mean by that?
Yeah, I think it's basically if I'm a non-dom, non-resident, and I'm buying a house in the UK, what's the best way to buy it?
Right.
I'm selling my property trading company shares. Do I have to take special covenants? Could I be caught by the anti-avoidance provisions? I'm a non-resident dealing in UK land. Shall I try to get protected by a treaty, or shall I set up an English company and let the English company make the gain and take the money out by way of dividend? So each one of these transactions which you're carrying out, I think has an optimum structure.
Right.
You have the right structure. You can give the right advice, but you need to find the optimum, which is the best one in the circumstances. And funny enough, I was just asked a couple of days ago by a non-resident, non-domiciled, buying a house for very many millions of pounds. It was a flat in London. And the question was very simple: how should I buy it? So it's an individual, a non-resident and non-domicile, which was the best way to buy it? And it seems like a sort of a simple question, but to get it wrong you'll see quite catastrophic circumstances, consequences. And so the first thing is, he said, should I buy it through a foreign company? In certain circumstances, that is the ideal structure. In others, it's not. For example, if he were to buy the property in a foreign company, and he was to live in it, his family or connected persons were to live in it, then basically that would be an unattractive proposition. That would not be the optimum structure, because you would pay the highest rates of stamp duty land tax, which is basically a flat rate of 15%. It's the highest rate. And secondly, the company would suffer the annual charge, the ATED, each year. So that would be a great mistake. On the other hand, if he were to buy it to let it to strangers, in other words, it wasn't used by the family members or himself, then he would pay not the high, he would pay a lower rate of stamp duty, land tax. It's still high, but not this punishing flat 15%. But it'll also not suffer the ATED, the annual charge. So the subtle sort of difference between those two was sort of massive. Now, if he says, well, actually, my family are going to use it, then he's got to think of a different structure. He cannot use a company. He may take a company as a nominee for him, but he couldn't take it in the company's name. Otherwise, he'll suffer this ATED. In this particular case, it's almost £100,000 a year, the annual charge to the ATED because of the price of the house.
Can I just ask you, Patrick, as well, if somebody, so with those two examples you've explained, is there a halfway house where a client may let it out, say, on short 6-month tenancies, and then perhaps during the course of one of those years, it's empty for a couple of months, just simply because of the comings and goings of tenants?
Yeah.
If he used it during, say, a 6-8 week period of one of those years,
yeah,
would the ATED bite then?
Yeah, the ATED's not as bad as it looks. It bites almost on a daily basis. So it's not an all or anything. So
okay,
if in fact he ended up using it for a period, then that's not the end of the world. If it's
right,
vacant, it's got to be shown to be trying to let it. There's a lot of revenue guidance in this, and one's got to really go through it very carefully. So it's not catastrophic. It is a daily punishment rather than one immediate punishment.
okay.
But in this particular case, because he is going to use it as the family members and himself, then he still bought it in the name of a company, but the company held it as nominee for him. Or perhaps his children, which may be a better idea for inheritance tax purposes, because you skip a generation. And the consequence of that is he does not suffer the ATED. He still suffers the high rates of stamp duty, land tax, because it's his second home. The thing which non-residents and non-domiciles have got to remember is that the capital gains tax and inheritance tax, the rules have fundamentally changed. So that property is within the charge to capital gains tax. And if he died the next day, he would pay inheritance tax up to 40% on it. So that he needs to be warned on that. So he may say, oh, well, I don't really want it in my own name. Put it into the name of a settlement, which is the third alternative. And he says, well, it gives me more confidentiality, and it can be held in a discretionary trust. So what's the consequence of that? You have no ATED, even if it's the name of the company acting as nominee for the trust. So you get rid of that. You've got to get rid of the ATED. And you mustn't get into the ATED. I spend all my time getting people out of the ATED. So last thing you want to do is get into it. So what's the disadvantage then of a settlement is that in the case of a settlement, if the settlor lives in the property, then when he dies, he still pays the full inheritance tax at up to 40%. But the settlement, of course, pays the 10-year anniversary charge, a maximum of 6%. And he may say, oh, well, I really want to settle. I don't want it in my own name. The only thing to think about is the 10-year charge applies if the property is held in settlement when the 10-year charge period arises. So if he sells it before the 10-year charge, you can say, oh, well, I've avoided the 10-year charge. But because of anti-avoidance provisions, he has to sell it 2 years before the 10-year charge comes about. So I was able to sort of say to him, if you're going to let to strangers, carry on with the company route. You know, that's probably the best route. If you're going to use it yourself and you want confidentiality, then probably why not have a settlement? It's not the end of the world. Don't die, by the way, because that's one of the problems in this. And maybe think about selling it in 8 years' time, or put up with a 6-year charge. So you see, it's quite intricate. He may say, oh, well, Patrick, I'll have it in my own name so I can leave it to my wife. And then I don't pay inheritance tax if we're both not domiciled in the United Kingdom. So you say, okay, that's quite a good idea. But then there's a way which you can, in a settlement, you can, if you die, leave it to your wife. You can leave her a life interest and get the spouse exemption as well. So it's quite a, it's a long story to get this optimum structure. But you've got to go through it, and if you go through it, it is quite satisfying at the end of the day.
And has he gone through it? Is this what he's deciding to do, or is he still continuing to consider?
He's still continuing to think about it. What he originally thought was he would let it to strangers, and he's now changed his mind and wants to start using it. And I think the way he's going to do it is he wants confidentiality. He's going to do it through a settlement, I think, and take a view whether he suffers the 6% charge, or whether he thinks in terms of possibly selling the property 2 years before the 10-year charge. I was
going to say, set a calendar reminder.
Yeah, a calendar reminder. And then at the 10-year charge, you just have foreign cash, and you don't pay the anniversary charge.
Right. So is it? Do you look at a lot of non-dom? Is that a lot of your client base, or are you looking at UK structures as well?
Yeah, I look at UK structures. Just one other sort of non-dom one, because or foreign one, and then we'll look at some UK ones. But one of the foreign ones is very often asked, look, I'm doing a UK trading transaction. I'm going to buy residential, commercial, develop it and sell it. What Mr. Soares is the best structure to use to do that? So the chap basically has no UK connections, but except for he wants to do this particular land transaction. Now you can look at treaties, double tax treaties, but you're really in for it. The revenue would be aggressive. Each treaty now contains an anti-avoidance provision, which says if you use this treaty to avoid tax, you don't succeed, which is a very tough anti-avoidance provision. So in the end, the advice I would give to say an investor from the Middle East who wants to carry out a trading transaction is set up a UK company, put in your, 10 million to acquire the property and develop it, so by way of share capital, and carry out the trading transaction. The company pays corporation tax of 19%, and virtually all dividends paid to non-residents are tax-free. And therefore, you can pay your 19% corporation tax and take the balance out by way of dividend tax-free. So in the end, the overseas transactions have become sort of massively simplified in that respect.
Just out of interest as well, when you say, well, obviously the anti-avoidance provisions are in the double taxation treaties. Just is there any ever? Well, there must be lots of grey area, but in terms of when is it just sound advice to advise somebody to structure it in this way? Because inevitably there's going to be an element where you are going to reducing the client's tax bill. So is it a matter of course that if you reduce the client's tax bill, that is anti-avoidance?
I think it's more that, are you using this treaty to try to avoid tax? So it's basically the acid test, for example, is there are many structures where you have companies set up in Luxembourg. Yeah. And the idea is a UK company would pay interest to a Luxembourg company and get a deduction for the interest and pay it gross. A lot of land transactions are in that form. You'll find English companies borrowing and paying to Luxembourg. And the question really is, in a nutshell, is if you've set that Luxembourg company up for the purpose, then the anti-avoidance provision would apply. But if you've got an established Luxembourg company for many years and you're making use of it, then you wouldn't have been said to have trying to make use of the treaty for the purpose of trying to avoid the tax. That in a nutshell is.
Say again, Simon?
Not so contrived and inflammatory as far as HMRC are concerned.
Yeah, yeah. It's basically have you tried to make use of this treaty to try to avoid tax? And if you've set up a company recently in Luxembourg, then the chances are you're going to be caught by that legislation. Yeah.
Understood.
Funny, I mean, on the UK side, the structures which we come across it. In a way, you need to try to get your trading profits so that they just pay tax at the corporate level, 19%. On inheritance tax, you need to try to get business property relief is sort of the basic planning. Capital gains tax, you wanted to get entrepreneurs relief, but that's not with us very much. There used to be the 3 prongs for planning to try to make use of those reliefs. But I mean, oddly enough, to avoid income tax, it's a good idea, obviously, for the profits to rise in a company. So you pay corporation tax 19%. But quite recently, taxpayers who have achieved that have sort of thought again and said, well, okay, yep, but I've got to think further. And what about inheritance tax? Because 40% of my company disappears. It's great to have it, but 40% disappears. And the movement there, I think, is to see whether you can make your company into essentially a development company. If you're a property development company trading in, as to a trading business, doesn't have to, then you can get business property relief. And so many taxpayers, they even put their investments into stock, and they have what's known as slow moving stock. I had one case where this taxpayer did have a lot of slow moving stock. And there has to be some element of development, otherwise you don't get business property relief. And the revenue accepted that on the death of the taxpayer, that it was slow moving stock. So you need to think a pure investment company, great, you've got your income paying at the lower rate, but can you make it into a property development company?
I think that's where a lot of our discussions are with Simon and I have with prospective clients is regarding the property portfolios that they're building up, and it's explaining and them understanding the element that there needs to be trading rather than just investment in order, because it's such a massive relief if you are able to fall within the parameters of what's required. But I think just simply having even 10 buy to let properties is not a trading activity per se. It's investment.
Some folks, so just looking at it from my perspective, as a building company, property development company. So we are a trading property development company. I mean, BPR hasn't even been on our radar screen as at this point, and we've got some projects coming up that and it'd be interesting to see how that might benefit our company at some point.
Yeah, I think you've really you've got to ponder on it, and it's quite a process. I mean, you ought to think of making sure that the name of the company reflects what it's doing, the memenarts and the meetings, because to get into a business property relief situation means you've gone from hell to heaven, really, isn't it? Because you really are in a tax-free position. And I think you need to really focus on that, but it's not just the transactions. You ought to change the name of the company to reflect the types of transactions you're doing, and it's so I've got a few on at the moment which are transactions which could be looked upon as sort of investment transactions or trading, and you need to sort of emphasize the trading aspects and really work on that, because as I say, the consequences are quite major, because at the moment as the law stands, if the shareholder dies, all the capital gains are washed on death, they're uplifted to death, and you pay no inheritance tax. So the effects are really quite dramatic. But it's not normal, you
So
know.
what are so Patrick, what are the key benefits to a property development company of using business property relief?
Well, it's just basically on the death of the shareholders.
Okay,
Yeah, there's no death duties. That's the key thing.
right.
Yeah.
Okay.
It's
Spoke to a client last week or the week before, I think, Patrick, and we didn't win the work in the end, even though we highlighted the BPR point, which was very annoying. But the client who we had a Zoom call with, and they were on the verge of paying £1.9 million to HMRC.
Yeah.
Because the mother, who was a developer, she passed away just under 2 years ago. So she developed properties, she stripped them back to the bare bricks and did major renovations to them. And then in the middle of the company, she kind of, I think for various personal reasons, she kind of held on to some properties, so slow moving stock, as you would call it. And then towards the end of her life, she was back again, knocking walls down and developing. But her current advisors didn't even address the point of BPR. We highlighted the point, and then they went with somebody else, which is quite annoying. But it's really asking the right questions and really having the knowledge to point these things out to the client.
Right.
Yeah.
But I think as well with that one's that matter, Simon, they the lady who had passed away had kept quite meticulous diaries about her activities. So there was also quite a lot of evidence to demonstrate that she was trading and that she was going to see estate agents and getting in touch with architects and doing various elements that would all constitute her running the business, like her trading and her qualifying for BPR. So there was evidence there as well, which is quite unusual.
Except they threw the diaries away, though. We did have the drawings, though. She used to do her own drawings, some plans. We had letters from various estate agents in the areas who could confirm she was a regular customer buying and selling properties. But anyway, we didn't win that work, so that's a shame.
I mean, on the question of inheritance tax, I mean, there is when you come to the principal residence, when someone wants to plan for inheritance tax on the principal residence, there is a sort of almost like a process you've got to go through, really, I suppose, to find the optimum structure. And the process really is if you've got your principal residence, and you want to avoid the inheritance tax on it. I mean, first thing on the list is you say, well, I could perhaps sell it to my children, and they pay me the full price for it, so there's no gift. And then, or I could actually give it to them. I mean, selling is on the list, but I could give it, and then I can pay a full license fee. And continue to live there, and I have to survive 7 years in that particular case, and the license fee will make sure that my 7-year gift period starts to run. And so in one case I had, it was given to the daughters, and inheritance tax looks at husband and wife as separate people, and so it was the husband who gave to the daughters. And we got Knight Franks to decide what the license fee would be. And under the terms of the license fee, he had to live with his wife, which means you don't have exclusive occupation, and it's said to be a detriment because you have to share accommodation, like sharing it with another tenant. And so that's one of the inheritance tax things you've got to take. Another one interesting, I mentioned, you've got to look at sale. Can I sell and get the cash? And then you're immediately out of inheritance tax. The cash is chargeable to inheritance tax, but if you're a non-dom, the cash could be left overseas, and that's not chargeable in any event. The other thing you have to look at for inheritance tax, there's only 4 of them. That's 1, 2, 3. There is, can you share with a member of your family. So if I own the property and I share it with my daughter, I give half the property to my daughter and I share it with her. I pay the expenses, or we pay our equal expenses, and they both live there. Then after 7 years, the half I gave to my daughter won't pay inheritance tax. Or if I gave her 9/10 and I continue to live there, it would still apply. And after 7 years, that would avoid inheritance tax. And the last one is what's known as the reversionary lease scheme, which you can use the word scheme because the revenue accept it, where you grant a special lease, which takes I live in the property. I grant my children a long lease to take effect in 15 years' time, and hope I live for 15 years. And then when the lease falls in, what I'm left with is with something of very little value. But do you have other tax consequences on that? So I think whenever the advisor is advising anyone who says, what should I do about my house? I think he needs to go through those 4 things and decide which one to do. In the particular case I've just done, the taxpayer in the end decided to give the property to his daughters and take out this license fee because he thought the license fee wasn't too much. You pay tax on the license fee, income tax, but it was a way of avoiding inheritance tax. So why I mention that is I think whatever one of those arrangements you adopt, there's basically 4 of them. You need to go through them and see which one is the optimum one in the particular circumstances. So you'll definitely come across those structures, and the ones which stand out, I think, are the gift with the license back and the sharing. The sharing does have very dramatic effects. You know, the circumstances are right. Father lives with his unmarried daughter, or the mother allows the daughter and her family to live in the house, and son-in-law, and they're able to share the house. It does have very dramatic effects on inheritance tax. It's a very specific exemption.
So with the sharing, for example,
Yep.
would you have to be mindful of not giving too much away in terms of sharing, because otherwise there would deem to be some sort of reservation of benefit? So you've mentioned, say, 9/10.
Yeah.
If you did it 9/10, could there be a query regarding, you know, reservation of benefit on maybe 3/4 tenths of that share, because obviously one other person can only use 1/10 of the property?
Yeah.
Which you wouldn't do. You would obviously all be within, or is that not really? Is that a non-point?
It's the way the legislation is drafted, really. I mean, it's very crudely states that if you own property, you become joint owners, and provided you pay your fair share of the expenses, then this relief applies. So it's quite extraordinary. So although I've always gone for 50-50 at being the coward that I am, it's said in the various books and diamonds and things that there's no particular restriction. So I think it is, if the circumstances are right, it does resolve the inheritance tax. The why it resolves it is you've got no, unlike taking a license and paying your children a license fee, you don't create any new income tax circumstances, and you're able to live in the property for as long as you like. You have to survive 7 years from the gift. So I've done that 4 or 5 times, and it seems to be without any particular problem. The license fee a couple of times, but people get worried about paying tax on the license fee. But when you actually sit down and look at 40% charge, it has a way of waking you up. I mean, I remember I have clients who just weren't listening to my advice, and I used to send them estate duty assessments showing how much they would pay. I remember sending that to the client, to the accountant to send on to the client, and I still didn't get any response from the client, because he had to do something because it was a huge estate. And I spoke to the accountant. He said, "Oh, I didn't have enough courage to send it on." Because you're saying to someone, "Oh, your days are numbered," so he never sent it on. So
I'm going to show my age now. It reminds me of a Steptoe Son episode where they divided the house in half, and it went to the middle of the kitchen. And anyway. That's great, Patrick. Thank you for that.
Yeah, thank you very much.
And now we'll go on to Mr. Bennett, who we've known for a few years, property developer and drinking buddy and a rugby fan. So, Michael, can you tell a bit about yourself and how you got into property and what you were doing at the moment?
Sure. Thank you, Simon. Well, my history has very much been in the software sector for many, many years. But in 2007, I decided to get out of corporate life, do a bit of consultancy. But prior to that, I had developed a couple of properties with a friend of mine who's an architect and a planner, and that seemed to go very, very well. But we stopped doing that just because I had to focus on building a career, basically, in the software industry. So after 2007, I decided that consultancy and doing some other things in my life. And then in 2013, after a long lunch with this friend of mine that I developed these houses with many, many years ago, he said, "Why don't we form a property company?" Which at the time seemed a cracking idea, and it's still a good idea, I should add. And that was the start of the journey, really. In 2013, Home County Properties was born, and we've done several developments, and it always amazes me just how long these things take if we've not been in the industry. But yeah, we've done several projects now, and it's been a very, very steep learning curve for me. I know a lot more about building now than I ever did, but I concentrate in the business more on the kind of legal, sales, and commercial side of it. So really, I'm all about, first of all, trying to find sites. So that means connection with commercial agents, estate agents, and just keeping a watchful eye out and contact with people using your network as you would traditionally do. And then once we find a site, to try and work out through Jonathan what we can actually achieve with that site. It's a classic sort of position, but what it tends to lead to is that apart from our very first project, which was self-funded, we've got into bigger projects now, which has really meant us delving into the third-party market for financing. And that's where I think all of our challenges come, and how we assess projects, finance them, and basically look at the feasibility of projects. And that's becoming increasingly difficult, especially with now, I think, with the end of the stamp duty holiday at the end of next month, there are talking about property prices maybe stabilizing, not so much activity. So it's getting quite a difficult balance now, and with funders particularly giving percentages on got a loan to GDV, as they call it, and that's starting to waver, i.e., sometimes reduce because they want to reduce their risk, and we've seen rates increase, although interest rates have gone down. So there's some interesting dynamics to play in the funding of projects, and so it's very important. And we certainly learnt this lesson early on, is to find the right lender that you're confident with, that will support you through a project and through thick and thin. And more recently, we had a project in Churchley where we built 3 terraced units, and of course we first of all we were plagued with the fact that we had to literally sack the contractor after the timber frame went up, which meant we had to get another contractor in, and all the issues surrounding that. And then we had a longer build because of COVID, which it just extended the whole process beyond. And very fortunately, we have, because it was under the Help to Buy threshold of 600,000, we were able to sell all 3 of those properties, and they're going through, just completing now, 2 first-time buyers. But it's been substantially longer than we envisaged when we first set out the process. Part of that was due initially to what we thought we could get on the site and kickback from the planners, and now we got planning. We knew we'd get planning, but what it was for. So I think the point I'm making here is that the whole property business if you're going to go into it with your eyes wide open, and make sure you really do your homework. And one of the good things I've found is working with a good third-party funder, is that there is check and balances in that whole process, whereby they look at what you're buying it for. They will do a risk valuation on that, and indeed what you're proposing to build. So they've got comfort in that. A valuer will also look at, QS will look at what your build costs are and validate those. So in essence, the feasibility study we do initially kind of gets validated by a third party and includes all the interest and profiling over the 12 or 18-month term, however long it is you determine. But there's so many variations and things that come into play. And I'm suppose if you listen to this podcast and you say, I want to be a property developer, well, just be mindful that there's some real challenges in doing that. And of course, in all of these funders, they want personal guarantees at the end of it. So are you prepared to put the family house, into that package, so to speak? You're guaranteeing it personally.
I was going to say you might be prepared to put it in, but your spouse might not.
But the learning curve must be.
I have to tell her that. Thank you, Amanda. Where's this podcast going out on?
Sorry, Patrick, you were saying. Sorry.
I was just saying, I often advise on the land transactions and the tax, and I look at you guys, often have digestive problems. Invariably, you end up with divorces, strange illnesses, and you're the guys who take all the worry. But I just think that the learning curve must be absolutely massive, mustn't it? The things you learn about yourself, people, money, finance must be massive, and the sense of achievement.
It was a big change for me, Patrick, coming from the software industry. I was all about running businesses and more commercial sales focus. That's what my kind of core skills are. So I brought that into the company, but fortunately, my business partner is an architect and planning consultant, and that's been so important to us, because we work on the basis that we both put our sweat equity into the property, so to speak. And he works on the planning, and that can be an expensive part of the whole process. Getting planning, you could spend 25, depending on the size of the project, £50,000 just on getting the planning application in. And if you start to do that speculatively every time, and you get it wrong, or you don't get planning, it can be a big cost to the bottom line. So we work on the basis that he does that. He's been doing it for a number of years. I've got confidence in he can get the right planning for the right site. And if we don't, and it hasn't happened to date, and I'm touching wood here, we just crack on from there. And then I go and look at all the things related to wrapping that up nicely with some third-party funding, and off we go. And hopefully we make a profit at the end of it. So yeah, all of those things, and the learning curve I went through was.
I think we've lost him.
We've lost him. I think he's way.
Oh, I think he's off on a learning curve. Right.
But I'm not so sure there are curves as straight up. He might be back actually, and then Olivia can snip this back together again.
Yeah. So where I used to come in is they'll have to work out the bottom line of all the expenses and everything else, and so the developer would want to see where the tax, how far that could be at its lowest rate, so that they end up with their profit at the end of the day. It was always this nice to sort of look at their calculations.
I think though it's probably, particularly with things as TV programs or whatever it is, gives you an impression that you can buy a house, do it up, make yourself 40,000 and move on. I think that actually the reality of talking to people that either do refurbishments or developments is completely different. I think it's interesting what Michael was saying about the length of time it takes, or it's certainly taken over the last year to get to this point. I think that's probably been hitting quite a lot of people.
Hello, I'm back again. God knows what happened there. I don't know why that was. You were all frozen. I'm still talking. I'm thinking, is he putting this to me?
Right.
I think it's actually your wife must have disconnected it because she's
Yeah,
like
yeah,
actually
that
listening to
probably
what you're saying.
Forget about that personal guarantee.
Yeah, I'm in for hell now when I go downstairs. I'll be,
I've got a question for you, Michael. So what happened with the timber frame people? Why do you have to sack them?
oh, it wasn't the timber. It wasn't actually the timber frame people. They did a great job. It was the contractor who started the whole process. So we engaged the contractor to demolish what was actually a Jehovah Witness meeting hall, prepare the site, you know, to dig all the trenches, put the slabs down, and get it prepared for the timber frame. It did all that, and then the company we engaged with had financial difficulties basically, and so it wasn't going to work for us going forward. So we had to quickly stop that and start again with a fresh contractor, which delayed the project, of course.
And from a lending
You
point
don't foresee that. You don't foresee that, Simon, when you start out this, because they actually worked with us on a previous project,
okay.
and it worked very well.
And from a lending point of view, what have you learned from securing lending? What's the best way? Have you got any top 5 tips on how to approach lenders?
I think my top tip is be open-minded. There are a lot of companies out there, and I think if you're doing this for the very first time, talk to quite a few of them, because you'll get there's a very broad spectrum of offerings out there, providing funding at different rates, different fees appropriate to the cost. And so the devil is really in the detail here. So talk to lots of them. You will always find, depending on whether you can get it's just going to be a senior debt only facility, or you have to put some mezzanine funding in there. And if you put some mezzanine funding in there, that can be quite expensive. All right, there are people charging up to 30% per annum.
Wow.
Mezzanine funding. And you have to put the mezzanine funding because the senior debt lenders say, well, we only loan 65%, say, to the gross development value of the site. Well, if your costs are in excess of that, and you need more money, well, the only way is either you dig into your own bank account or you take out a mezzanine funding loan. So the mezzanine funding loan goes in there day one, and it comes out at the end. So it's there throughout the whole of the project. Whereas senior debt funding, of course, is phased over the development of the whole project. So you have to be mindful of checking those two things and the fees that sit behind it, and just be comfortable that the bank you're working with, are in this for the long run, because anything could happen, literally, and it has happened to us in terms of that one site in Chertsey. The contractor we had to change cost us money to do that. They stuck with us, and B, we've had COVID, which has elongated the build process.
Yeah.
Jen, you might get one of those, but you wouldn't get 2 of those, hopefully, again.
So if you knew what you knew now, would you do it again?
What a great question, Simon. Oh dear. I tell you what gives me a lot of comfort. Okay, and I don't think I would have. Well, there's 2 sides to the story. Yeah, I might have done. I'm at the point now where, because I've built up my own personal family's net wealth, so to speak, I can sleep comfortably at night. That if this should go all wrong, I know, because I'm in property, and if I've got planning permission, something, I've increased the value of it. And if all things should go wrong, I might walk out of there just equal or whatever, on that basis. But if you don't have that comfort, and you're living on the edge all of the time, thinking about, will I lose my house on this basis, then you should think long and hard about it. And if I was to think about that maybe 30 years ago, I don't think I would have taken that decision to move, if you like, almost full time into doing this. That's for sure.
Good
So
answer.
it's not so much a learning curve as you just go straight up. There's not much of a kink in the curve, is there?
There's not. I mean, I did have the benefit of doing it twice already, so I knew how it worked. I mean, but all of that, both those projects were self-funded. But it's when you get into using third-party funders that it really takes, that's where it starts to grip you. And then you've got the complexity, of course, and this is where, Simon, you would know more about this, is that it's some companies that we lend through, they don't want to put this site into our core company, Howley County Properties. Yeah. They want a special purchase vehicle. So we got to set up, and then you get the complication. Well, if you've got 2 or 3 of those, and that's going to hopefully be happening very soon, is you've got this complexity of 3 companies, and how do we best structure that for the benefit of home county properties and us personally from a tax point of view.
Yeah, because most clients we see now in Zoom calls, they often have 4, 5, 6, 7 JVs already, and they may have half of it or a third of it, and they also have a partnership in their own name properties as well, and they want to form a group structure. So it's more complex. You kind of get them 6 years into their kind of property journey, I suppose, wrong word, but so it is quite complex.
Yeah. It's not simple. I'm enjoying it. Don't get me wrong. I'm enjoying it. I'm enjoying the mental challenges of it. The whole legal sales and of course one of the exciting bits is right at the front end. We've got 2 projects on where we've got what we term option agreements over to buy the property subject to planning. Just doing those deals is what I enjoy. So it's good fun. I'm enjoying it.
Good stuff. Okay, guys, that's brilliant. Well, thank you, Patrick, and thank you, Michael.
Thank you very much.
Okay.
Pleasure. We'll see you again. Keep safe.